Thanks for joining us, Stephen. Let's talk about this thing the markets have got right now, with investors focusing in on the negative and shrugging off any positive news out there. What do you make of that?
Well, no surprise. The market does climb a wall of worry. So at this point, we're looking for whatever's wrong in the market, and until those problems recede, and whether it be sovereign credit risk, whether it be Asia stemming growth, looking to rein in some of the real estate prices, the bubbles forming on commodities, for example, financial regulation, energy, obviously in the forefront in the U.S. With the Gulf spill. So, certainly there's a lot to worry about right now.
Some signs, though, that people are beginning to think, hey, hang on, things have been a bit overdone and we're a bit overcooked right now. Perhaps it's time to dip a toe in.
Absolutely, yeah, we think so. I mean, at 1,200 plus, the S&P 500, just as one benchmark, we thought was getting a little bit pricey. Our year-end 12-month target was about 1,280, so it represented only mid-single-digit growth from there.
Stephen, let's talk about what your role is. I mean, I think it's something like 2,000 North American, European, and Asian securities. It's quite a responsibility. Now, you're the one who decides whether they're buy, sells, or holds, if you like. How do you actually decide making that call on a particular equity?
Sure. Well, we have 90 analysts around the globe covering, as you said, almost 2,000 securities. So U.S., London is our hub in Europe, and Singapore, Kuala Lumpur, and Hong Kong, the hub for Asia. So analysts are really focused in on bottoms-up analysis. What are the drivers? What are the catalysts for individual companies? And two, what is the economic situation? So at any given point, where are we on the cycle? What should do well? What cycles should do well? Right now, obviously, we're having a lot of difficulty with revenue growth with companies. So analysts are really looking for companies that are able to generate revenue growth through this cycle, or if not, if they still have a lot of cost-cutting capabilities.
Well, that's the point, isn't it? I mean, bottom line versus the top line here as well. And we've seen a lot of people just cutting that bottom line and not getting the top-line growth that they're seeking.
That's right. That's where most of the growth has been, actually. Our analysis on first quarter earnings was that we had about a 7-to-1 ratio of beat for earnings versus revenues. So revenue growth still very difficult to come by. Earnings growth still being generated through margin expansion, productivity gains, et cetera.
What can we expect in the next earnings season here? What are you getting in terms of the ground-up, look at whether we are seeing a return of the sales growth?
Well, not so much. The first quarter is likely to be the strongest in terms of earnings growth, but as we go through the balance of the year, the next 3 quarters, comparisons are going to get a little bit more difficult even.
Really? What about double dip? Is that a serious possibility?
Well, you do hear some credible sources. Our economist is not in that camp as yet, but I guess it is a risk at this point.
Obviously, we can't just talk about it generally, but I'm talking about Asia, Europe, and the U.S. Who's in most danger of that? Probably the Europeans?
Definitely, yeah. I mean, obviously, that's where the weakest growth is. They've got their hands full with sovereign credit risk in general. Very high interest rates that have, if you look at the fiscal mismanagement that's taken place, that's really taken a toll.
So that obviously focusing on and concentrates the minds on European companies looking more like cells than anything else. Well, walk us through some of the companies that you like. Let's be positive, shall we? Here.
Sure.
Let's talk about like Teva Pharmaceuticals, a generic drug maker.
Yeah, absolutely. In the healthcare space, and we are overweight healthcare as a sector in the U.S. As against the 500 as benchmark. This is a company that's grown through thick and thin. Basically, it's got a very strong pipeline. Generics as well. The healthcare reform that took place, obviously, companies focusing on cost cutting, governments focus on cost cutting as well. So, any move to generic. You also have a lot of name brand drugs from the major pharmaceutical manufacturers coming off patent, and of course that will be great for generics.
Overweight technology as well. Why?
Well, again, that's where the growth is. We've seen a lot of the consumer spending also gravitate to those areas.
And I notice Apple is not one of your top picks, even though it's now become the 4th biggest company in the world. Has it just gone up too far, too fast?
Well, our analyst has a buy on Apple, not a strong buy. So it's not one of the ones that they focused on. But
who's a strong buy then?
IBM is one example of a company that certainly moved much more into the services area. Emerging markets doing very well. We've got some other buys in technology like Flextronics as a contract manufacturer. Obviously, a lot of companies seeing that as a valid outsourcing method for cost cutting as well, and certainly in the sweet spot. If you look at things like digital cameras, LCDs, things like that that are made by this company.
Stephen, thank you so much for coming in and talking to us about that.